Is the team engaged? Are there good systems in place? Or is it kind of all stuck together with duct tape?
Okay, welcome back to the Marketing Playbook, presented by Details Interactive. Here you'll take away 3 game-winning marketing plays every episode to take back to your team. I'm your host, Mark Friedman, and my career has been focused on direct-to-consumer marketing, direct mail, physical retail, and digital commerce. This is episode number 52, and today's guest is Fan Bai. Fan is an angel investor and co-founder of Hedgehog, an e-commerce holding company that buys direct-to-consumer brands. Fan and his team have identified an underserved buy-side market for those brands that have gained some traction, but have not yet been able to grow to the levels they'd like to. Before we get started, a quick thank you, as always, to Max Branstetter of the Wild Business Growth Podcast for producing this episode. You can reach him at maxpodcasting.com to help bring your podcast to life. Let's open the playbook. Ready, break. Well, hello, everyone. Thank you for joining the Marketing Playbook podcast. Today, I'm joined by Fan Bai. Fan is the founder and chairperson of Blank Label, a tailored menswear business, and is also the co-founder and CEO of Hedgehog, an e-commerce holding company that buys direct-to-consumer brands. He's also an angel investor in consumer brands such as Branch Furniture, Brightland, California Cowboy, and 10 other brands. Fan, welcome to the show.
Mark, it's great to be with you. Super excited. I'm very grateful to join the other stellar guests that you've had on the show. So thanks for having me.
It's my pleasure. And, thankfully, there are people like yourself and the other guests that have wanted to share their story and help some people that are early in their career and even some people that are more senior in their career continue to learn a little bit. So let's jump kind of into your background. It's pretty interesting. And, one of the things we do on the show is like to give everybody a sense of where the guests, kind of have come from and how perhaps, their upbringing gave some light, might shed some light in what they do today. So tell us about your early career.
I'm still relatively early in my career, so just for context, I've in my mid 30s, I've really only known kind of e-commerce and mostly operating as a kind of founder. So my background is I was born in Shanghai, grew up in Sydney, Australia. So kind of had a pretty typical immigrant experience, which I think is a part of my identity still. And seeing my family or living through my family kind of frankly escaping, communist China and, looking for, pursuing their own capitalist pursuits. So my parents were small business owners in Sydney and kind of seeing the benefits of that as a big part of who I am today. And so planted that seed of, wanting to work for yourself and working hard and being able to kind of have the agency of working for yourself and, being able to reap the rewards of that as well. So I'd always wanted to kind of start my own business and out of college kind of was, this is 2008, 2009, the entrepreneurship was just starting on college campuses. So this was like a few years after Facebook, and this was in Boston at the time. Was inspired, and I was like, always had an interest in apparel and clothing, and so started Blank Label, my first business, which is a custom menswear business. Operated that for, we started online, started eventually opening stores, and operated that business. That business has been around for 12, 13 years now. And so, and only a couple of years ago, kind of transitioned out of that business. It's still run by management. The business is still run. It's run by a management team. And now with Hedgehog, which I'm sure we'll spend some time talking about.
Yeah. So there's Blank Label, and then there's another business, Black Lapel. And when I was, doing my prep for this, I see, chairperson of Blank Label, Black Lapel. That just totally threw me. I was totally confused. It was so similar names. What is Black Lapel?
Confusing externally, it's sometimes confusing internally. We started a business called Blank Label, custom men's clothing. A couple of years later, there was another custom men's clothing business called Black Lapel that started. And the quick funny story is when they launched, a couple of friends of mine, like, sent it over and said, "Hey, what's going on? Is this you guys or like?" And I was like, "No, it's not us." And one friend even said, "Hey, you should like send them a cease and desist. This is too similar sounding." And we've always we have an abundance mentality of always, happy to be friendly with our peers in the space, and so reached out to them. But in this case, I reached out to them and said, "Congrats for launching." But in my head, I was like, "Hey, I'm a little bit peeved." But the gentleman, the founder, Warren, was so nice that, after the conversation, I was like, well, I can't not like this guy. He's such a nice guy. And so that was, 8, 9 years ago. And so we'd stayed in touch. Fast forward, custom menswear gets incredibly impaired during COVID. 3 or 4 years ago, you and I may have been wearing dress shirts, possibly a sports jacket for this call instead of two polo shirts for the listeners. But so incredibly impaired, and basically, he and I were crying on each other's shoulders. And the long and short of it is, we decided to buy them, and that's the story of Blank Label and Black Lapel.
Okay, got it. Let's switch gears a little bit to, the concept of investing. You talked about entrepreneurship. The investing landscape has lots of terminology. There's angel investors, there's seed investors, then there are, rounds, Series A, Series B, Series C. So maybe just give us, a minute or two on the landscape of investing, and we'll talk about where you play in it in a minute. But give us that perspective of the different kinds of investors out there.
High level, there are two types of investors, and I'd really break it down into kind of angels defined as non-institutional, and then institutional investors that have their own investors called LPs. And the biggest difference is, at least in my mind, the term angel, as far as I understand it, derives from Broadway angel. So, decades ago, when a Broadway show was getting launched, it was, an angel willing to fund the production, and it was really a passion project as much as a financial return. And I think about startup angel investing as a similar, it's, hey, people that have backed us, we're looking to pay it forward, and it's, we want to see these things exist. We want to give a backpack to passionate, driven entrepreneurs looking to build something in the world, and we're definitely looking for, a productive outcome. And given that we're at the earliest stage, the, return profile can be quite attractive. But we are not. It's kind of, we don't have a fiduciary responsibility up the chain to our own investors, but, kind of vis-a-vis an institutional investor. So that's kind of how we think about it. And then, like I said, angels are earlier stage, whether you want to call that a seed round or friends and family, and then once you get into the Series A, Series B, et cetera, then you kind of get into the institutional investors that are typically writing the, $5 to $50 million checks.
Right. And, when you think about the current, climate, we're talking, we're in the middle of February 2022. What are you seeing in prices for companies that you're looking at? Has the market, continued to be on fire as it was, over these last couple of years? Are you seeing it flatten out? What's your perspective at the moment?
Two factors. One, which is, again, mid-Feb, you'd put even consumer product startups bucketed in with tech, and tech's being, largely written down in the last 3 months in the public markets. And so I think that there is potentially impact for some drag, which I'll talk about in a second. And then the second is just like consumer products, brands impacting in the VC ecosystem, which in the last 2 years being a little bit out of favor versus, let's say, 4 or 5 years ago. And so on the first part of things like Casper and Peloton, other large consumer brands that have been so impaired in the public markets, and that's starting to trickle down, I think our friends up the up market in terms of the Series B, Series C, $100 million brands that are thinking about going public in the next 12 to 18 months, they're starting to feel the pain of, hey, they're getting marked down a little bit, but it hasn't trickled to the early stages yet, not in kind of the seed and Series A. There's still so much private capital that's yet to be deployed or needs to be deployed in the next couple of years. So I think, again, knock on wood for us being in that space, but we haven't seen early stages prices come down, and we'll go out to market in a few months ourselves, and the feedback that we've gotten is it's still very, very hot for the kind of top decile opportunities. It's still very, very hot. So, but I will say on that second part, in terms of VCs finding consumer brands a little bit out of favor. We've heard that a lot from all of our consumer products friends. Well, I should say, our VC friends that did invest in consumer products 5, 6 years ago, when when it was pretty sexy to do so, and there was this thesis that you could build, billion-dollar consumer brands, and the reality is only maybe half a dozen or so ended up playing out. I think now that's kind of gone out of favor, and they've gone back to their more traditional tech investing, 90% gross margin businesses instead of 50, 60% gross margin businesses that have physical products that are harder to scale. And so I think that's become more challenging. You again have to be a really, really have top tier metrics as a consumer brand to kind of attract more of those VC dollars.
Yeah, it's interesting. You and I have talked a little bit. I do some, small. I'm not even sure that I'd characterize it as angel, but some small investing, and I like the early stage companies because it helps me learn. It helps me, pay it forward, as you talked about before. But I look at even the investments that I have made, the ones that have performed better over these last 3 years or so, seem to be the ones that are technology, SaaS kinds of platforms, as opposed to the smaller early stage consumer goods. They've got a product or two or three, and that's what they're trying to sell. So even for somebody like me, I could feel that kind of shift happening. So let's talk about Hedgehog. Tell us what Hedgehog is.
Through the blank label and lapel experience that I mentioned earlier, that was really the inspiration for Hedgehog. So I had operated blank label for about 10 years. We were like most of, a lot of the consumer products folks that listen to this podcast, we wanted to build a, $100 million revenue, large consumer products business. And that's really hard to do. And we built a nice size business, but hadn't fully broken out yet. We had 6 stores, 35 employees, but it hadn't fully broken out yet. And the challenge was like we were always looking to grow top line revenue, and so we were less conscious about EBITDA. And so when we started to have some of these exit conversations or explore these exit conversations, they were like, you're too small for strategics. You're not like at that 15 to $20 million revenue that like a strategic can start to even be bothered dealing with. But you're also not, gushing in EBITDA. So you're kind of stuck in this messy middle. And there are really no buyers of that. And we're like, hang on a second. This is like, there's still remnants of a good business here. We have a lot of repeat customers, good amount of organic traffic. It's a going concern business. And it's worth something. I don't know if it's worth $100,000, $500,000, $1 million, $5 million, but it's not worth nothing. And moreover, like a lot of our consumer products founder friends ran their businesses in a similar way. We're like, so what happens to all of these? So that was part one. And then part two was when we did buy Black Lapel, one of the things that we identified was we're like, you have an inventory planner, we have an inventory planner. Like you have an email marketer, we have an email marketer. Like you have a photographer, we have a photographer. Like, and so naturally we thought there were opportunities to combine, do a shared services model, and that played out. So a couple of quarters later, we're like, oh, this is actually working. And so the fact that, so again, highlighting those two things, that there was no buy side for subscale, not yet profitable brands, but we thought that there was still value, and that we were able to actually unlock some of that value. And we're like, we should just do this as a standalone entity, outside of focusing on a custom niche, focusing on a much broader category, starting with apparel, but we'll go into other categories. And so that was the thesis, and yeah, it's been a blast.
When I look at some of these smaller businesses, and I've had lots of conversations with early stage folks, how do you decide when you look at the business whether it's a business or it's the hobby of the founder?
So we've definitely seen a lot of passion projects, but the reality is often a passion project or a hobby can turn into quite a good business. So our criteria is that like we are looking for a high quality business, and that's across two lenses. One, which is we're looking for quality revenue, and looking for a going concern business. So the quality revenue is really like, what is the non-paid revenue? Does it have a repeat trail? Does it have any organic or referral traffic? Or is the business completely ad driven? I think completely ad driven businesses are really hard to make work. And because just, you know, ad businesses, pricing changes, it's an auction marketplace, Facebook CPMs go up and you're out of business. It can work for a while, but it's hard to sustain. So we're looking for, is there a lot of quality revenue here? And the second part, as a going concern business, like, is the team engaged? Are there good systems in place? Or is it kind of all stuck together with duct tape? And if it is a quality business and they have good processes, but it's not yet profitable because it's trying to grow too quickly, or there's kind of a lack of internal expertise with planning or P&L management, these are things that we can fix. But yeah, the kind of quality revenue is really the main market that we're looking for.
And so when you think about, acquiring a business at this time, is it generally with the idea that the founder or whomever has been running will continue to do that? And, I've been involved in quite a few multi-brand, both catalog and digital businesses, over time. And there's been, this age-old discussion of it, should it be decentralized or centralized? And if the model is centralized, it's usually some form of a hybrid centralization model. So as you think about how to leverage, right, because you're building a leverage play, how do you think about what the structure should be?
The founders typically move on, but we generally want team members to come over. And so the founders move on because they want to move on. Like that's usually the first conversation. And it's a founder that's been at it so we generally only buy brands that are aged of 5 years plus. But our average age is probably 8 or 9 years. So the brand's been around for a while, and the founders tired. We deal with fatigued founders often, and so they're looking for a good home for the brand, but they're looking to hand over the keys. And then in terms of operations, yes, so we run a very centralized model, and then effectively have pods. So across our portfolio, we've got kind of a premium women's wear pod, we've got a subscription business pod, we've got kind of a lifestyle apparel pod, and we'll have kind of design and marketing within those pods, and then some horizontal functions kind of across, whether that's accounting and legal and compliance, or a people function. But yeah, it is fairly centralized.
When you look at a business that might be, out there for 7 or 8 or 9 years and has not been able to achieve, the kind of scale that one might want, is there not an underlying message there that maybe there's not a business there?
That's a great question. It depends on kind of what the expectations are in terms of what is a good business, and what is a business that's kind of worth working on. So we generally don't buy businesses that are sub $3 million in revenue. But north of that, like if it's a 5, 7, $10 million business, the founder might, in often cases, the founder's like, I've been at this for 8 years. I don't know that I want to keep running a $5 to $6 million revenue business, especially if it's kind of EBITDA neutral, or like, lose a little bit of money and we've raised a couple of rounds. But in our case, we're like, hey, if we can get this business from 6 to 7.5 to 8 and do it profitably, and have an $8 million business doing $1.5 million, $2 million of EBITDA, that's actually a pretty great outcome if we can stack together a couple of dozen of those. It definitely needs to have some small element of scale, again, north of $3 million, ideally north of $5 million. But again, we would be quite happy with that business, even if others wouldn't. We don't need it to be a $25 million, $50 million revenue business. There are other people that want have that prerequisite, other institutional players, or low mid-market private equity firms. But again, that's where we think there is the white space. Like, we are often the only bidder. It's a proprietary relationship. It's deep empathy with the founder, and it's the operating model that can run a $6 million business and run a lot of them together that we think is our edge.
As you think about, as you're talking, more questions keep coming up in my head. When you think about these businesses, are you looking for synergy, across the businesses from a customer perspective, so that, Mark Friedman, may ultimately, be a customer of one brand that you buy, but now because you're compiling synergistic businesses, you can now sell more things to me?
Synergies across a couple of areas. So customer persona is definitely one of them. And our pods kind of pods follow that structure loosely. And then second of all, like, we just learn a ton. We learn a ton from brands that we don't buy, but we learn a heap ton from the ones that we do buy. And we'd like to think that we, are giving a lot of expertise, but we're also getting a lot from each brand. And like, oh, they've got a like nifty tactic around, this or that thing. It's also, where we often try to bring the talent that's coming with the brand and elevate that to, a holdco level. But yeah, customer persona, taking the customer persona, introducing it to more products is absolutely a core part of the strategy. And then finally, in terms of synergies, it's also overlapping wholesale accounts. And so I'd say 30 to 40% of our brands do some wholesale. And so yeah, often we're getting introduced to good wholesale doors so it's as much cross-pollinating customers as it is cross-pollinating wholesale doors.
And some of the brands, and maybe before we talk about, I was going to talk about Marketplace and Amazon. Can you mention any of the names of brands that you own today?
Yeah, so we've got a few brands in women's wear. So Rec Room, Francis Austin, Og Mercer, and again, these are all subscale brands. So I wouldn't expect that any of the listeners have heard of them. But then in lifestyle, we've got kind of Wear, Fayette Chill, Bridge and Burn, and then we've got a couple of subscription businesses as well, which will come online in the next month or so.
Okay. And all of this is under the Hedgehog umbrella. So if listeners want to understand which brands are part of Hedgehog, they can go to your site and see it. Is it all up there?
The site needs an update. It's a funny conversation internally where there are two slightly different views. We've got a very muted site at the moment, but yes, presumably it will be updated soon.
Okay. So folks, don't go to Hedgehog. Reach out to me. I'll get you contact information for Fan, and he'll tell you what brands are there. Do you have a direct-to-consumer business? I enjoy connecting with guests on this podcast because it reminds me what I love to do: strategic and tactical consulting for businesses like yours. If you'd like to speak with me about your business and see how you can add a fresh set of eyes to your team, contact me at mark@detailsinteractive.com. Now, let's get back to the marketing playbook. Let's go back to Marketplace. Are you looking at businesses that have as their core competency, direct to consumer, either through wholesale you mentioned, or on their online business, but that have some component of Marketplace, as opposed to businesses that are predominantly driven by Marketplace?
We are not a marketplace first business. We are definitely a direct to consumer first business. And for that matter, we are not a retail first or a wholesale first business either. As you would well know, and had other guests talk about on this podcast, like the marketplace aggregation bonanza is competitive. And so we definitely don't look to go ahead on there. Similar to wholesale, although maybe slightly higher percentage, but yeah, maybe 40 to 50% of our brands will have done some wholesale. And so we're looking to do marketplace, when we'll obviously look to continue that, and we'll try to bring our other brands to marketplace where it makes sense. And so yeah, like at some scale, we think that D2C is probably still the large majority of the revenue. That's where we like to play. It's we love owning that customer and owning that full LTV trail. LTV is a very important part of our D2C thesis, and mentioned earlier, kind of owning that customer then across different brands as well. So owning that customer data is really, really important. So we'll always be a D2C first business, but presumably at some scale, marketplace and wholesale will, be 15 to 20% of revenue each, and then the large majority being D2C.
Right. There's so many headwinds for consumer businesses these days, whether it be supply chain, cost of acquiring new customers because of cost going up with Google and Facebook and other digital platforms. How are you guys dealing with these headwinds?
We definitely experienced some of that pain ourselves, but I would say, to be honest, it's been a net benefit because we are a buyer of brands with some flavor of distress that it's created probably accelerated deal flow. And in terms of how we deal with it, so we are category focused, at least to start. So we expect our first, let's call it 25 million in revenue to be in apparel. And so that makes our supply chain a little bit easier to manage. We have both onshore and offshore manufacturing vendors that we work with. Again, so that can kind of load balance. We have quite a few premium and luxury brands, so air freight is very viable. So we've been able to manage the supply chain situation moderately well. And then in terms of iOS 14 and increasing ad prices, again, I would say that because we have a portfolio approach and because our holding company is predominantly at this stage a large buyer, we're like we think there's a big buy side opportunity. The aggregate kind of holding company can grow pretty aggressively, even if our organic growth is only 20% a year. And so to hit a 20% marker of a high quality business is much more achievable than trying to grow it at 30, 50, 70% a year.
You mentioned a few times we. What does who makes up the we in Hedgehog?
Yeah, so we've got what, a dozen plus, maybe 12, 15 FTEs at this point. Management team is a head of product, kind of overseeing supply chain, design, and planning. A head of marketing that is, ad buying, affiliate, email, and then a head of ops, which is customer experience, retail, because we do have a couple of brands with their own standalone retail people, fulfillment. So we have functional heads in those three, and then I spend most of my time talking with founders. Talking with a handful of founders. Yeah, probably talking to about 10 founders a week at this rate. Just walking them through the exit process. Sometimes they're like, "Hey, I'm not sure I'm interested in selling, but I got introduced to you, and I want to learn more about it because I've been running a brand for 5 to 10 years, and I feel like I need to put my head up and learn what my options are." And so it's often a conversation like that, or it's a, hey, we're actively thinking about a solution, and we actively need to look for a solution. And so yeah, but that's where I spend most of my time.
Where does the deal flow come from? You're not out there advertising that, hey, you're looking to buy companies, so it's got to be some networking. But where does it really mostly come from?
Our key belief is that there's no buy side for subscale, not yet profitable consumer brands, and so there's a lot of white space there. If our key belief was we wanted to buy profitable Amazon businesses, it would be much, much harder. So that means that through our network of the founding team collectively having about a dozen plus years of e-commerce experience each, that we have other D2C founders, agency friends, consumer products investors that know that this is a problem. And so when they come across something, we're really one of the only places they can send it to. To answer your question more directly, where do the most deals come from? It is from other founders. And so it's other founders in our network that say, hey, because founders are usually the first person that you tell over a beer or a catch up, and yeah, look, it's been we got hit really hard last year. Yeah, it's been a grind, and I'm thinking about next steps.
And oftentimes there's this proverbial playbook. That's kind of a word, obviously in my podcast, the marketing playbook. But do you have a playbook that you've now established? I've seen these portfolio businesses, and they want to bring on these new businesses, but it's almost like they're recreating the wheel each time, and it's a fairly inefficient process to onboard a business. How are you dealing with that?
Yeah, absolutely. So we definitely do have playbooks for really each of our functional heads. We've got a due diligence checklist, and we kind of interchange this checklist and playbooks. But with this due diligence checklist of what's in our buy box, and we're learning over time how to improve that. And then there's a kind of transition checklist. Hey, here are all the things that are must-haves pre-close that we don't want to get anything. We want to hit the ground running. Usually we're working even with their team on their business pre-close just to make sure that everything's buttoned up and rocking and rolling. We've got this growth marketing playbook, kind of 3 rings. The first ring being the low-hanging fruit around improving ad structuring and testing, email signups and flows. And that's kind of the lowest risk, best principles. The second ring, once we feel like we've saturated that, around marketplace, and then marketplace, affiliate, non-core, paid social, and then the third ring kind of being wholesale, influencer, kind of other experimental, kind of higher risk, or and so yeah, we definitely have kind of systems, and from again all the things that we've individually learned over the last 12 to 15 years, specifically within D2C e-commerce.
All right. How are you funded in order to support the acquisition of these businesses?
Yeah, so we've you know been inspired by the our peers in the marketplace aggregation world, and kind of, so we're funded like a traditional startup as opposed to a fund model, and so done the pre-seed, seed, and we'll go out for an A later this year, and but yeah, funded like at the holdco level like a startup.
Got it. And for you as the CEO of this business, what are your biggest challenges that you face personally, day in, day out?
Pacing is something we spend a lot of time thinking about. Pacing in terms of going too fast or too slow. We think that it's a huge opportunity. We want to buy every brand that we talk to. It's a problem we're deeply passionate about solving, which is, because we were in that position ourselves, we deeply understand, like, you put all this work in, and now you're a little bit too small for strategics, not quite profitable enough for a financial sponsor. You're totally stuck. Like, it's the pain that I still like understand very deeply. And so, and you're staring in the mirror being like, but I know there's a good business here. Like, why can't anyone else see it? So yeah, we're very passionate about the buy side, and so always want to go faster there. But we actually need to operate these businesses, and like in some cases, need to implement our playbooks, and then it's about scaling an operating team, and you want to have the right people on the bus, and it's growing quickly enough that we're basically a different organization every quarter or two. So pacing is something that making sure that everyone's aligned on what we're trying to do, and the speed at which we're doing it is something I spend a lot of time thinking about.
Oh, that's good information, good stuff. Thank you for all sharing so much information with us. So we're getting down to the end of the show. We like to do this 2-minute drill. We've got 7 questions for you, 1 or 2 word answers. You ready?
Absolutely.
Okay. A brand that you admire or that inspires you.
Yeah, I don't know if this is cheating, but there are a few brands that come to mind, and these are all legacy brands, but have to love the likes of a Patagonia or a Nike or Starbucks, like multi-decade, still feel like 30, 40 years on, they're kind of still in their prime. Yeah, that derives a lot of inspiration.
Building lasting businesses, that's for sure. The favorite app on your phone.
Twitter.
Okay. All right. We'll be watching or looking for your tweets. The last website other than Amazon that you shopped from.
It's a friend's brand, but it's a company called Italic that is kind of doing a membership model, factory direct, similar to Costco, but for premium goods.
Ah, interesting. Something that you're not good at, but that you wish that you were.
Um, I'm always trying to become more economically rational. What I mean by that is I'm the type of person that's like, I'm still thrifty enough that, like, hey, I'll spend like 30 minutes on trying to save $17, but then I'll not think about spending $600 on, and so yeah, always looking to be more economically rational.
Okay. That's a first. Economically rational. Okay. A charitable organization that you're passionate about.
Yeah, I'm sure that there's a ton more that I can do here, and we really think about it as a family. But both my wife and I are involved in a local school, which is a nonprofit, and try to spend time there. And even longer term, education is probably the area that I'm most passionate about.
Good. And if you had one superpower, what would it be?
I'd like to think that I'm patient and have a long term outlook. So I want to be at this for a while, and yeah, so long term thinking.
And other than your family, what's your most prized possession?
Probably related to the last question, which is my health, which has definitely had some ebbs and flows with the chaos of running a startup. But yeah, it's something I try to be conscious about.
Okay. Where can people reach out to you on social media? Lots of good information today, and maybe they'll want to reach out to you and try and sell their company to you.
Yeah, so we're the hedgehogcompany.com. You can easily find me on LinkedIn and Twitter if you just search my name, Fan By. Yeah, always happy to help. Like, that's our general view, which is there isn't very much education around this topic, around exiting your consumer brand, and so we publish some content, including on social media. But yeah, always just happy to be helpful and point folks in the right direction. Often case it's not us, right? Like, often case it's like, hey, we're really profitable, business, we're like, great, you should like talk to these three brokers that we've had good experiences with, or we're a really high growth, high scale brand, and again, that's probably not a fit for us. And here are a couple of bankers that we know that we like and trust. And so, but yeah, always happy to chat.
Okay, great. Fan, this was really interesting. I love what you're doing. Hope we can stay in contact going in the future.
Absolutely, Mark. Thanks so much for having me on.
My pleasure. Thank you. That's it. Today's game ball goes to Fan Bai for coming on the Marketing Playbook. To me, today's 3 game-winning marketing plays were as follows. Number 1, even with a market that's been on fire for years, there's still so much cash available to be put to work. If you're involved with a business that needs cash to grow, or even if you're looking to cash out, you've not missed the boat. For the right business, there's still available capital to be raised. We did hear fans speak to the fact that consumer brands might not be looked upon as favorably as technology companies, but don't give up if you're focused on a consumer brand. Number 2, a company like Hedgehog is looking to unlock the value in a business that for whatever reason, current management or the founders were not able to do. Portfolio companies make a lot of sense, the concept of leveraging shared resources, but many have tried and failed. At the end of the day, it's about the brands you bring together and the execution. And number 3, businesses that are completely ad-driven are really tough to sustain. You must be able to develop quality revenue from other sources, whether it be from building your brand and gaining traction in organic and direct load traffic, or from wholesale or retail channels. But you cannot only rely on what you spend with Google, Facebook, and Amazon. Thank you, Playbook marketers, for listening to another episode. If you want to check out more pages of the Marketing Playbook, make sure to subscribe on your favorite podcast spot and leave us a 5-star review on Apple Podcasts. You can follow us on Twitter at DetailsInteract and learn more at detailsinteractive.com. Until next time, the devil is in the details.